a keynote speaker for you this morning, and he's going to bring us into the new age.
Oh, wait. Sorry. I forgot a really important thing.
Oh, what is that?
The reason we can leave is because George Milo called. Remember, that's the grandson? And he said, we're good. You guys met each other. You partied last night. I see Brandon here. And you guys are going to go and change the future. And they said it's already changed, but it depends on you. So are you ready? Are you doing it? Yeah. Okay. Okay. All right.
Tap there.
On the count of three. Let's wake up, people. Okay? On the count of three, we're going to see if you're ready to change the future. All you have to say is, yeah!
Ooh.
And we're standing up here cross-dressed, so I hope that you'll do it. Are you ready to change the future?
Yeah!
All right, go ahead,
I heard him up in the gold room, too.
Gold room.
So we have a fellow here this morning named Shaun Stewart. No, it's not Rod Stewart's son. I knew you were thinking that. No, different. But he does have a good story. He's from Australia.
Oh, I love Australia.
And he was going up to college in New York. Yep. I forget the name of the school. What is it?
Well, it doesn't matter. That's the point. That's the end part.
Oh, okay. I delivered the punchline too soon. Is that what it was?
Yeah.
Anyway, from Australia, going to college in New York. He flies to New York City. The college ain't in New York City. So he got there anyway.
Ithaca.
He was going to
drive
Ithaca.
6 hours.
Yep.
He didn't even know where he was going.
Oh, my Lord.
But he's come a long way since then.
Did he make
I think
it?
he is smart now.
Did he make it here?
Yes.
God help him. Okay.
I don't know where he is.
He's a seasoned professional. He's got...
Yes, just like us.
Yeah. He's never had an introduction like this.
First time ever he's been introduced by a cross-dressed man.
Yeah, exactly.
But this is that year 2021 where they got all into that.
It's all over.
Yeah, go ahead.
It's all over after this anyway. Anyway, without further ado, ladies and gentlemen of the vacation rental industry, please help me welcome Shaun Stewart.
Woo!
Do you ever have those moments where you're like, my partner thinks I have a serious job and I go do serious things and I'm being introduced by two cross-dressers at 9 in the morning? It's good to see you guys. Nothing is better than the 9 a.m. slot the morning after everybody's out till 2 in the morning. So I hope you got your coffee. I'll try to keep things at a high energy pace. I've met a lot of you before, so that's probably a good or a bad thing. We'll take some heckling from a few in the audience. But I've been in the space since moving here, as the introduction mentioned. I came to Cornell, the hotel school, landed in New York City, thought Cornell was in the middle of New York City, got a bus from Penn Station that I thought would be 20 to 30 minutes, took 7 hours, and ended up in Ithaca, New York. And since then have been just passionately studying and being a part of the hotel industry ever since. I worked with Expedia from 2000 to 2010, mainly doing supply deals, working with people like yourselves to figure out how to distribute accommodation inventory around the world. Did that again, building a company called Jetsetter, which was more focused on the luxury set in the travel world. We sold that to TripAdvisor, and I worked for TripAdvisor for about 1.5 years after that. Then moved my family to California in 2014 to help build the Airbnb business, mainly focused on leisure markets, looking at how to grow their kind of performance outside of urban city centers and into the leisure space. And then went out one night, got drunk in a bar in San Francisco, and woke up with a job at Google doing self-driving cars. And I don't even know how it happened. My wife is still explaining it to me. But I spent 4 years there developing Waymo, which was Google's self-driving car company. And then I moved back to Brooklyn, where it all started. And I run a place called Newlab in the Brooklyn Navy Yard. It's an 86,000 square foot facility. We have 900 people there, technologists, entrepreneurs. We raised $1.6 billion over the last 4 years and have built 202 different companies in advanced tech. We've sold about 480 million of them so far. But we look for industries that aren't adapting or understanding early stage technology well. And we build companies that disrupt those spaces. We love when industries or CEOs say that the current state of everything is perfect, because then we look for what they're ignoring and try to build that and monetize that. I'm not here to sell anything. I don't work in travel. I'm an investor. Love the Rent Responsibly crew, and I've invested in NoiseAware and a couple other companies, but that's all I do now regarding to travel. So I'm just here to tell you what I'm seeing and following from the industry, hear your thoughts, answer questions, but without selling you anything. So you can tell me I'm wrong or right. It's just my 2 cents of being in the industry for a couple decades, just like you. What's clear is VR was already in the biggest seismic shift it's ever seen. But pre-pandemic, we were all talking about how this was continuing to go from one out of 10 trips in the US to 2 out of 10 trips in the US, 4 out of 10 trips in the US. And what happened during the pandemic was a level of fuel just got added to that fire that nobody's ever seen before. And I think I go back to the way my dad used to travel. My dad had one hotel he stayed at in London, always the same hotel, the Duke, just near the Ritz there in Green Park. And one year in 2015, I said to him, I'm working for this company at Airbnb. Why don't you try booking an Airbnb in London? And instead of his little hotel room at the Duke, he got a 2-bedroom with a kitchen. When my mom snores, she could sleep in the spare bedroom. He had a better location. Never stayed at the Duke again. One exposure to vacation rentals and what they offer, and you typically convert people. That was the Airbnb mantra. Get them to do it once, and they'll be with you forever. And it was always the approach. And what happened in the pandemic is a whole bunch of people tried it once. They couldn't go to cities. They wanted to go drive market. You can't drive to the hotel that you wanted to go to anymore. Or you had COVID concerns about the health of that city or that hotel. A lot of people just got exposed to this category, and what's great about what you all do is once you expose them once, they convert. That's an amazing product, like if you have a product that does that. So what we look at and what I track all the time is just 4 things, and they're all interconnected in VR. You look at what's happening with supply. Is it growing or diminishing? Is there more supply available or less? What does that supply look like? Where is it being built, and how's it being constructed and managed and operated? Then you look at the demand side. Where's the demand coming from? Is it going up or down? And how does that balance out with the supply, which usually results in ADR trends that we'll talk about today. Then you look at the user experience. The scariest thing about vacation rentals today is that what made this industry so popular and what converts people with that level of success is actually diminishing as things scale. As you get bigger and bigger, you start to look more like the stuff that we competed against and less like what brought people here in the first place. And we'll show you some kind of statistics and numbers to prove that out. And then the last piece is how it's all being priced and distributed. You can hate OTAs, you can be 100% direct. In the end, most industries in travel have had to build relationships with all different channels. They've had to figure out how to distribute through third parties. They've had to figure out how to use agencies. And they've had to figure out how to build direct strategies. And you kind of always want to be tracking how those are going. When I first got invited to go present to the board at Airbnb about why they should build a vacation rental strategy, I showed a slide that said by 2027, this will be a $60 billion industry. Since I presented that, that number's doubled. This industry is exploding in size and addressable market, the capital being deployed, the amount of professional supply being developed. The demand channels are proving it. VRBO said it's had the best year it's ever had in 25 years of being in the vacation rental industry. And that's consistent across all of the different distribution channels you look at. They're all having gangbuster demand years. And vacation rentals came back way stronger than the hotels did. Took you guys a little bit of time to ramp up. You didn't see the growth or the index pop up above hotels on occupancy until about July. But from then onwards, we outperformed all of the hotel segment in the US on occupancy, and it continued to be there. The unfortunate reality of everything I say today is there's a big asterisk because we're all waiting to see the last 2 months of data. And what we're seeing is high cancellation rates in states where you've got hospitalization rates going up with caseload. You've seen it in Texas already. You're seeing it in Florida now. You're seeing spikes in cities with high vaccination percentages, which aren't resulting in caseloads in hospitals, which aren't resulting in travel disruption. Then you see states with the opposite, plateaued vaccination rates, high hospitalization rates, which is impacting travel. Austin just said they don't have room in hospitals. If you're traveling to Austin, you probably thought twice about doing it now. That's what's happening as you look at the data for cities. So we've got 2 months of data that's missing. We'll show you a little bit of the trends that we suggest is happening there, but that's the one hard part. The recovery hit leisure first. All of the growth in demand went to the leisure markets before it went to urban for obvious reasons. And it also hit the smaller hosts first as well. And that's mainly a lot of the data skews towards smaller hosts of 1, 2, and 5 VRBO listings because they just make up such a large percent of the market still. This is still an incredibly fragmented supply market. And so when you look at the professionalization occurring, that's one of the things that's appealing a lot of these big bucks of capital is that there's so many small operators. And there's a combination of arrogance of like, we can take the small operators and make them better, or they see it as opportunity that there's operators that are willing to exit their businesses and actually move their supply into larger kind of categories and aggregators. And throughout this period, when people said, shit, I got to drive upstate New York for my family vacation instead of going to Europe of what we usually do, they thought, well, who can I trust to find me a house or something to stay in? And a lot of them tried name brands they'd heard of and knew before. They went to places they knew. If they were Expedia people or Airbnb people or Priceline and Booking people, they went to those channels. Skift reported they expect a 10% jump in the OTAs of market share from 2020 into 2021. That's insane. You track these market share industries at 1% and 2% jumps. Like a 2% jump in market share is like a celebratory thing. A 10% jump is like a seismic shift to one direction, which is these OTAs just got another step forward in their strength of demand because all these people got unlocked into what you do, but they need a name brand they can trust. And if they don't have that in a Marriott or a Hilton or a Hyatt, they go to the distribution players instead. And so with all this demand growing, the key question then becomes what's happening with supply? Because if supply is outpacing demand on the growth side, then there's flat ADR, there's different outcomes of that. But the reality is supply is flattened. This is Airbnb in the US. That's a plateau of 6 million listings for about 5 months. They grew 60% for 2017 to 2019 in supply growth, and they grew 1% the 2 years following that. Supply is getting harder and harder for these distribution players to access. Urban supply has slowed down. If you actually break it urban into leisure, leisure's still growing, about 15% supply growth in the leisure markets. But the urban city centers that have got more regulatory problems, plus obviously a pandemic that killed demand, it's actually slowed down or declined supply growth in the urban city centers. Now that may recover and fuel back up on the urban side, but it's the leisure side where you're actually seeing the most amount of interest and capital being deployed on the supply side, which we'll talk about. But all of this has resulted in what I've heard for the last 2 days on every panel, which is rates are up significantly over prior year. The trend is just this yellow line is 2021. You obviously saw the hit in 2020. But again, like a market share growth of 10%, a rate jump and an ADR for an entire industry this significant is just really rare. And so we're going to have to track, like, does it flatline, does it actually pay out, or does it go back as supply comes back onto the market? And so today you have this imbalance where your product is great and rare and people are willing to pay more for it. But the result of that is that there's a shit ton of money being thrown now at supply development. And you're not talking about hundreds of millions of dollars. Someone announces a $250 million supply fund, fine. There are 4 or 5 people developing multi-billion-dollar funds to buy homes and distribute them as vacation rentals because of how attractive your industry is, because of the demand that's soaring, and because of the plateaued supply, which is people want this product. When they try it once, they love it. It's high margin. It doesn't have a lot of the intensive operations you've all seen here today. I get room service each morning at 7 a.m. here for coffee. That's not profitable for them. Those things are missing from the VR business that make it attractive. And so now you're just seeing a significant professionalization or interest in the capital side. But don't think this is like, oh, we're going to wake up tomorrow and it's all going to be destroyed. This takes a long time to move. This takes a long time to build homes, build properties, buy and acquire and operate. If you look at this is the average number of listings an Airbnb host has in the US in urban versus city centers. It's growing, it keeps going up, but it's slow. So there's a massive amount of fragmented supply to move. This isn't overnight going to be big chains and big brands that show up, but that's the movement and the direction it's going. Every year I say that, like, I'm excited by the level of interest in the industry, and a year later I come back and it's like doubled or tripled. This is the highest level of activity we've seen in this field for sure. So if you're seeing an acceleration of professional supply, more money being thrown at building larger amounts of inventory, probably professionalizing and making it more consistent as a guest experience, what's going to happen to what actually made this industry unique in the first place? Like the reason why we all adopted after single experiences. And this data continues to be true, which is the larger operators get, the lower the guest experience ratings are. It's just natural. If you're going to do 10,000 units, what you typically see is you don't get the level of service experience, customer reaction that you get when you're running one property. That kind of makes sense. It's pretty easy to run my one house in Sonoma to provide a great experience to every customer. You tell me I have to run 500 of those, it's more difficult to scale and still provide that kind of close attachment. And so although it's a difference on the Airbnb side, we use their data, you go from a 4.6 average once you're north of 100 listings to a 4.9 for the people who only have one property. I don't know if you get an Uber, but what do you think when you see an Uber driver who's a 4.6? You're like, what the hell has this guy done? Like, everybody's a 4.9 or a 4.92 or a 4.88. Like, a 4.6? I'm not getting in that car. And that's where this range is here, is that actually is a significant difference in quality of experience that's coming out from these hosts. And so that's what's concerning, is what happens if you accelerate the professionalization that grows to worse experiences in the market, that commoditizes the supply, which destroys what actually made all of us pretty unique in the first place, which is where we are today. And so for operators, the first thing is the value of your supply, the appeal it has, the leverage you have with distribution players has never been as high as it is today. It may go down, or it may go up from here. It may be that a ton of supply gets developed and your power and authority and ability to negotiate actually goes down once that supply grows. But at the state it is today, your power of the asset of inventory has never been as significant in value as it is today. Never. I've never seen the level of interest in distribution of OTA supply. Expedia wants it. VR supply is wanted by Priceline and Booking and TripAdvisor. Everybody. This category that's been ignored for so long for some of the bigger players is now just clearly in the crosshairs of their major growth. And so the new buzzword across all of the distribution players you meet is exclusivity. And we've been here before. This happened in the hotel space, and I'll tell you what happened in the 2000 with the exclusivity push. But if you think of vacation rentals in the US as a pie, 49% of that pie is exclusively listed on Airbnb. They still have the request model, the independent hosts, the urban folks who never tried this before. They're all loyal to this channel still, and that's their biggest asset. What the stock market can't figure out about Airbnb is how they grow beyond this. Are they car rentals, flights? Like, are they capped out? Because experiences isn't doing it. What's going to grow beyond just accommodation for them? And so despite 300% growth in their Q2 earnings, they still had a 5% down stock price because people are like, where does this go from here? What's the Uber Eats of Airbnb? What's the next product line that expands them? But today, it's all about that exclusivity number. Who can get the most amount of supply that is literally not bookable other than direct on any other distribution channel? And that's what they seem to have all decided is the fight. Priceline's a little bit further ahead than Expedia on that side. Expedia's exclusive inventory is largely through VRBO. But what's happened now is you're starting to see distribution agreements being negotiated between these OTA players and vacation rental property managers and distribution companies that have components to them that we've never seen before. They're starting to negotiate these things and factors because of the leverage you have on supply that they've typically never even discussed with vacation rental suppliers. The first is you can just look at margin itself. Margin wasn't really a negotiation point. Airbnb was 3%, take it or leave it. This is what Priceline offered. Because there wasn't a lot of supply growth and a lot of large players that had that leverage, they typically didn't take margin to the table as something you could negotiate. You're seeing these deals now. Because if you're Vacasa or whoever you are, if you have 10,000 listings, the distribution player is now worried about you. You're a big enough piece of supply that if you disappear, that's a problem for me as an OTA. My goal is to sell as many rooms as I can at the maximum rate I can as a distribution player. I know you'll hear this stuff about they just want to sell it for cheap, cheap, cheap. It's actually not true. You get measured at an Airbnb or a Priceline or Expedia on revenue, just like a hotel. So you want to sell as many of the rooms as you can at the highest rate you can. If you don't sell it, you lose because you lost inventory. If you sell it too low, then you lost out too. We created dynamic pricing, the automatic pricing beta test at Airbnb after one New Year's Eve in 2015, which is the average Airbnb host sold their New Year's Eve inventory for the same price as a week before New Year's Eve. And for Airbnb, we said, shit, we could have made 30, 40% more money if these people just know how to price. Let's start actually giving them guidance of when they're too low, and that launched kind of the smart pricing piece. So the OTA's goal is to try to sell everything, not at the lowest price, it's just at the maximum you can get, because you're in a margin business. If I can get you to sell it for $100, that makes me more margin. So it all makes sense. But you're starting to see these margin deals happen, where they're actually pushing and negotiating down my access to supply in exchange for better terms on distribution, which hasn't happened before. You've also started to see SERP placements, which as guarantees in contracts. So the early OTA days, Expedia, they guaranteed Marriott. Every 10 hotels in the results, you get one hotel. Starwood, you get a hotel in the top 20. They would negotiate placement in search results. The dirty secret of OTAs, 80% of transactions go to the first 10 things you see in the results page. You actually just need a good 10 listings to return a result. You're going to Rhode Island for this period, I need 10 good options for you. And that's, you can maximize conversion within that small set. So what they've started to do is do deals where they're guaranteeing exposure placement because they need the supply, especially if it's exclusive. Never would have negotiated with that type of offering in the past. Then merchandising, you're starting to see commitments around emails. Like, we're gonna do an email once a month about your vacation rentals, your properties, your destinations, as part of the distribution agreement. These weren't usually concepts that you would throw into VR distribution deals, but they're popping up now. And then the final category, that big E word, the exclusivity side, is you're starting to see property managers and vacation rental distributors or asset owners doing deals that have exclusivity terms to them. They're doing exclusively, like, I'll sell direct and I'll sell on Priceline, but nowhere else. And what will you give me if I do that? Then you're seeing the same on pricing. I'm gonna list everywhere, but I'm gonna price it the best with you. There was a panel yesterday that talked about people putting 20s and 50% increases on rates by channel. So now you're getting people saying, well, what if I just get the best rate I can out of all the channels out there? And those are starting to be at deal terms that we really haven't seen traditionally. Exclusive inventory, I'll give you the summer every year. I won't put it on Priceline, I'll put it on Expedia, or I'll put it on Airbnb in my own website. And then exclusive terms. You've even seen deals where you get better cancellation terms on one channel versus the other. And so rate parity, it didn't really exist in VR. It's already being fragmented in very different ways, and a lot of them through these kind of supply and distribution deals. But the reality is, the battle for direct is still damn hard. Marriott, Starwood, Hilton, Hyatt have been fighting to be 100% direct for 2 decades, and there's still 1/3 of their business comes through the OTAs. The biggest, most well-funded hotel chains out there have yet to figure out how to beat one truth, which is when you and I go shopping, we'd rather go to Macy's and see 10 brands than go to 10 different stores one at a time to see them all. And that's what the OTAs offer, is that selection that continues to just be hard to compete against. You can build up the best brand, the best direct experience, and you'll continue to grow your direct percentage, but the concept of going 0% OTA distribution remains really hard, at least for what we've seen in the hotel chains in that area. So direct's actually come down. Google's in that other category that their search engine widgets are now driving a lot of transactions. Airbnb's doubled its market share in VR in 2 years, thanks to, especially to the accelerant of the pandemic. And VRBO is still growing. The Expedia leadership there has certainly had some positive impacts on the conversion and product side. But the last 2 thoughts I'll leave you with, because I know I'm 2 minutes left. The first is, this all happened before. And the big question is, will the OTAs remember what they did with Vegas? Which is, in 2000, there was a huge bloody battle for Vegas, which is who could get all the inventory. Travelocity was the big guy at that point. Travelscape was acquired by Expedia, which was built in Vegas, had Vegas DNA. And everybody wanted to get the best offering of inventory in Vegas they could get. Supply was like it is today in vacation rentals, which it was the most popular thing out there, and everyone needed to figure out how to get access to it. So what did the OTAs do? They lowered margin deals again and again, and they did exclusivity. You take the Venetian, Travelocity got the Venetian, they lowered the margin to 12% instead of 18%. They got the Venetian exclusive. Then Expedia reacted and went and got the Wynn and the Bellagio. And they got those exclusive, and they dropped their margin, and those weren't available on Travelocity. And it went back and forth until they divided the market in half. Expedia had half of Vegas, Travelocity had half of it, and they'd both lowered their commission and distribution terms like by half. They'd lost all this margin. And what do you think happened to their booked room nights? It stayed the same. Because what they found out was the people booking on Expedia actually didn't care which casino it was. They're like, I want a 4-star place. I'm open to the Venetian, but I'll go to the Bellagio. Wynn looks good. Cosmopolitan's okay. And what you actually found was, wow, this inventory is a commodity. People actually don't care that much which casino they're staying at. And so all the OTAs did was lower their margin levels to end up with the same production, which was a terrible business outcome. But one exception stood tall out of all of it. You remember the Hard Rock in 2000? It was the coolest hotel in Vegas, and it was the hotel that everybody wanted to go to, and it was actually one that you didn't have a replacement. It was off strip, it had a different vibe to it, and so what you actually learned, and where the Airbnb irony of all this comes into it, is that the most leverage you had in the supply was if you had size of inventory that they were interested in, but you were different. If you weren't a commodity, they didn't know how to negotiate against you because they couldn't replace you with another alternative. And so you can build 10,000 units in Destin, Florida. If they're identical to 10,000 other units that a customer will not care which one they stay in and won't have a brand alignment, won't care if it's this one or that one, then you're actually replaceable in these distribution players. They want you, but they know they have an alternative, and so your leverage diminishes as a result. While the alternative, if what Airbnb asked for, Airbnb always resisted property managers because they said they were all cookie cutter. They wanted unique inventory, unique experiences. If you do that, if you build scale with unique inventory and unique experiences that guests actually flock to from a brand and demand perspective, your leverage is the highest it can be because they can't replace you. There's not another supply, access, or property manager that is easily put in front of a customer that replaces it. You want to be the Hard Rock and not the Venetian or the Bellagio, because then your leverage at the table is stronger than it can be. And with that, I'm open up to questions. I'm right on 30 minutes, but certainly appreciate your time, and thank you for having me here today.
Don't be afraid.
So Jeff from Teaming Vacation Rentals, where do you think rate parity is going, like Vrbo's? And they've called us and kind of asked us, okay, your pricing looks different and, API issues or whatever. But, basically, the lowest price is always on our website. Where do you think they're headed with asking for rate parity? And do you think they're going to try to do that?
Yeah. The more you can understand like these market managers, these people that are in a position to manage these destinations and what they're motivated by, the more you'll start to understand how they're going to strategize, which is, in the end, they're responsible for two performance in a market. Like I own Florida at VRBO. I'm the market manager for Florida. Maybe that's a bit big. I'm responsible for Fort Myers. My goal is revenue first, so room nights times ADR times the margin I can negotiate. So how do I get the most amount of inventory access? How do I sell as much of that inventory access as possible? And how do I get the best rate and margin out of that? And if you do that, you look like a rock star, you get promoted, you keep growing. And so in some areas, they're aligned with you. They want to grow rate. If you can sell it for more and I can sell it for more, we should sell it for more because we'll both make more money. And so there's alignment there. Now, if they're going to promote you, and we said like first 10 listings get 80% of demand, so your first goal is how do I line up this awesome menu of stuff? And if one of my options out of the 100 people I can show is providing a cheaper rate directly, and I know that if you see the listing, you Google it, you go direct, and I'll lose you, what do? The market managers are running their own stores. So they're going to have this huge amount of supply. They only need all the inventory for like 30 days a year when the market sells out. The rest of the time, they're going to sell like 50% of their inventory, and they just need to promote the 50% that's going to convert, going to give them good revenue and margin and rate. So you can tell them, I'm going to give you a 20% higher rate for the rest of your existence, take it or leave it. And they'll probably take it, and they put you at the bottom of the list, so it's something you eventually get to on high demand dates, and they'll use your inventory when you need them least. But the inventory that plays their game, they promote it, and they drive more business to it. And so you have to decide the strategy there. Like, do I want to give them equal access to inventory and rates? Does it work out well? How does it actually compare in cost? I mean, Airbnb's 3%, covers the credit card commission. What's a direct booking cost you when you pay MasterCard, Visa, Amex, all the other fees involved? So you just have to like a non-emotional analysis of what does each channel cost you and how do you want to manage them. But over time, people will play the game. They'll give them rate parity. They'll promote them more. Others won't. They won't promote them more. And some will get more or less demand from them. So you have to decide the strategy for you. Does that help, or is that a bunch of more? Yeah.
Shaun, thanks for all of this. Thanks for coming.
Of course.
A question on the 60% market share for listing sites and OTAs. How is that actually calculated? Because over the past 18 months, most of our clients have seen their fastest growing channels direct. And on those kinds of metrics, I think outside, people have had a historically very difficult time tracking call-in bookings, email bookings, a lot of the ways that you're getting direct traffic.
Totally.
And so if you're only looking at kind of black calendars on scraping stuff, you get a distorted view of how they're performing relative to the market.
Yeah. Yeah, it's kind of amazing we still don't have a Smith Travel for vacation rentals. Like, we still don't have a source of truth in distribution data. That stat was from a Skiff research paper where they interviewed like a couple thousand PMs across the US, gave them data access on where their revenue was coming from for the last 18 months, and then they extrapolate that nationwide. So like any data point, It's not going to apply to everybody, but if a general trend across like a few thousand US PMs kind of suggests where that trend will go. So maybe it's not 10%, maybe it's 12, maybe it's 7, but generally I believe that data showed like the right trend. And then I apply it emotionally, which is like, yeah, all my friends said they now love VRBO or Airbnb. I'm still a VRBO person, I'm not adjusted yet. And Airbnb, like they all discovered vacation rentals in the last 18 months and they had a brand that brought them to it. Maybe they found people through Google and went direct, but a lot of people I think were exposed through names they trusted. Keep going, yeah.
So, I mean, just when you were talking to Jeff, you were saying, what's the first thing they do when they see the listing? They Google that and then see if they get it correct. So then how do you reconcile? Maybe they initially came into it from channel.
Yeah.
But people, just like with kayak, you might see the flight, and you're like, I want my points on Melbourne. That is the cheapest of none.
Yeah, I think, so there's a couple things. Like one, I'm pretty comfortable behind a computer and I could find a listing in the vacation rental industry from Airbnb. My mother can't. Like you tell my mom, like find this listing, like half the time the listing names are different. The distribution players don't let you promote your brand, so it's hard to find. The best way to do it is a Google image search, which I do, and try explaining that to my dad, like how to do a Google image search. So yes, there are people who are savvy enough to go find you direct, but the reality is, and the further you get up in the spend, like how much money you have and your income level, you don't cross-search as much. What was the last thing you bought on Amazon? Did you search what it was direct? No, I bought paper towels last night, Brawny, I bought a 24-pack. I'm done. Like, no, I didn't go search 4 other websites for the paper towel comparison. That's a large amount of travel demand. But they're savvy people. My wife searches everything before paying $1, so she'll find your rate for sure. All right.
Shaun, how about, right here.
Oh, yeah.
Oh, hi. My name is June Butner, and I work for a company in Vermont. Burlington, Vermont just recently passed a law banning vacation rentals.
Oh, wow.
Where is this going in the country? I've heard that other places have already looked at it and are doing it. And do you have any information on that?
Yeah, it's definitely not anything that's happening at state, federal levels, obviously. Like, it's something that's still happening more at regional levels. And without plugging with one of my investments, but I think the organizations, like a lot of what we talked about today is how do you get growth in supply and scale, but keep what makes you different? That's where your leverage is the sweet spot, right? I grow my supply access, but I'm still unique and in my own way. If you're not going to do that through building and acquiring lots of homes, associations that build you guys as a single unit that can then go negotiate with power against regulatory changes are really what's needed in these smaller markets. There needs to be a central voice defending that vacation rental industry segment. And in some markets you're seeing that, where there's actually associations and organizations that can have an impact on these things. But the challenge is with such a fragmented industry, you've got like 50 businesses in the Oregon coast that represent all of the supply. They all have to be saying the same thing at the same time to actually make an impact on some of these regulatory changes. And a lot of times that's not there. So if you look at the heat of regulatory pressure, it's died down, if you're being honest. Like the Airbnb battles with cities aren't happening anymore. There's a lot of tax and remit in place. Most markets are being more and more comfortable with it, but there are anomalies for sure that are still fighting the battles. So I don't think it's died down, but it's not like, I consult in this space. Very little of the projects now are about regulatory. 4 years it was all about regulatory. But I think my view is like as much as this industry can, the smaller unit developers and property managers can team up and have a single voice to fight back, that's where we've seen success. Thanks.
All right, Shaun, you mentioned the 9 o'clock spot's tough. We have some people that just realized where they are and what's going on. You give us, Mr. or Ms. Individual Property Manager, 2 things to go home tomorrow and start working on right away.
Oh, Jesus. I mean, I think there's a lot we talked about. So, yeah, so many different things. So one is I would think about that regulatory question. Bad law comes to town. How organized are you guys? Who do you call? How do you get together? How do you all fight back as a group? And if the answer is, shit, I don't even know anyone in this industry in my town, that's probably a bad answer. So like, how prepared are you for the regulatory change that comes, which is pretty interesting to me. The second piece is, are you planning to grow supply? And if you are, how are you going to not lose your soul when you do it? because that's going to change how you perform out in the long term of this game, which is there's going to be a ton of new supply coming, and it's all going to be boring. I guarantee it. If people are building 2,000, 3,000, 5,000 units, they're going to want consistency. They're going to want them all to look the same. They're going to need to scale operations. It'll be call centers. And that experience of when I went to like St. Augustine and had my host, the PM, walk me around town and introduce me to each restaurant owner and coffee shop owner, that'll not exist on that supply. And if you can maintain that, that's what actually people flock to a little bit more these days than anything else. Then we had questions about cross-listing and finding your stuff. How easy is it to find your listing on Airbnb and find it? It's an interesting challenge. My mom and dad can't find shit from Google. See if they can find your listing. And see if you can actually build it so it's searchable in a way that answers that guy's question, which is how easy is for it to get that billboard effect. And then the rate parity discussion, how much does every distribution channel actually cost you? Everything. You're on the GDS, the CRS, what's the annual subscription rate? What's the booking rate, the cancellation fee? What's your credit card commission? Who's paying for it? Do you need insurance for that channel? Like every single thing you pay to be on a distribution channel, everything you pay to run your own direct website. You host that website, you do updates to that website. How much do they actually cost you? Then make an informed decision about how you distribute. It's really easy to get into the emotion of like it's Darth Vader is the OTAs and we're fighting against it. It's not that simple. It's not that black and white. And anyone who tells you it is just trying to get some emotion out of you to do one thing or the other. Run the numbers. Figure out what distribution costs you. And make an intelligent decision from there. Oh.
Shaun, this is great insight. And I got to tell you, this might be one of those keynotes I have to watch a couple of times over just to take it all in.
Appreciate that.
So you said you're an investor.
Yeah.
Would you buy Vacasa stock?
It's a great question. So when I invest, I'm an angel and seed investor. I get in really early. I write small checks into crazy companies and hope one or two of them finishes the race while the rest of them blow up in my face. Not in travel. Most of my investments are in frontier tech, quantum computing, biofabrication, AI, ML, like a lot of weird stuff. And when I invest, you start with the team. Who are the people? What are they able to do? What have they been able to succeed? I remember the first time meeting those two brothers from Vacasa 5 years ago, and I walked out of that meeting being like, those guys ain't gonna do shit. Like, they are crazy. And guess what? They weren't that crazy. They actually executed and operated well. They built a very valuable business, and hats off to them, because I wouldn't have bet $1 on them back then, and they proved me wrong, and they proved a lot of us wrong. So first is like, there's some proof in the pudding there of execution. You can love or hate Sonder, you can love or hate Vacasa. They are where they are. They're billion-dollar valuations, which is better than I've done in the last 4 years, right? Then the second piece is what are they going after in the addressable market? Everything I've said to you here today suggests there's just massive opportunity in this space. So much fragmented supply. There's PMs who are on any spectrum of I'm tired and I just want to go home and want to sell my business, through to like I've been doing this small business and I haven't kept up with the times, and there are ways to improve the financial performance of my assets, my supply, and a Vacasa strategy can come in and probably access that. So they passed those first two hurdles for me, like impressive execution and team so far. The market that they're going after seems clear and open and addressable for them. Then you get to the third question is, what am I investing at? What's the valuation? And what are the terms of my investment? That's usually where I fall down. Unless I'm like, I'm not investing at a $200 million valuation or whatever it is, because you think it's already inflated. So my yes or no would be based on what the valuation is. It's SPAC IPO, right? That's where they're headed? So you see where the pricing's set and see whether it's a valuation you're interested in. Airbnb's IPO is set at a $62 price per unit. What's that, a $46 billion valuation? Opened 1 minute later at 142, a $90 billion valuation. Went up to 200, 110 billion. Those are insane valuations. Like that is not a company today worth 90 billion. The naysayers will tell you Tesla isn't either. Like they're betting on Tesla as a stock because it's the future of automotive. Maybe Airbnb is the future of travel. Maybe Vacasa is. But the concern I would have is the valuation. I think it's pretty high at what they're setting it at today. But outside of that, I don't think it's a bad place to put your money. Did I contradict a whole bunch of things I said already? Call me on it. All right. Rock and roll. Well, enjoy the rest of your day. Thanks so much for listening to me for half an hour.